All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for Monday, September 17th, 2018. And this month is half gone already. And while we've been able to see some gains in the markets, we continue to see just this choppy action that continues to happen. There's a number of things that are going on and not going on. You know, that I titled the commentary, markets are bored. There's no real direction for anything economically or, anything for the market participants really to grab onto and get enthusiastic one way or another. One of the things that I will be discussing today, you'll see on topics, we're going to go through the stagnation of the markets. We're going to talk about the FANGs, which appear to be really starting to affect the NASDAQ a bit. And then we'll talk about the Fed, because next week we're leading up to the Fed. And as you may have noticed this morning, the 10-year actually traded up to 302. Backed off immediately, but we'll go through that here shortly. As we look at some of the releases that are coming out this week, this is my point right here, is there's really not a lot. Today is a nothing day. Empire State Manufacturing's out. No real material changes. There's a fair amount going on about the housing markets this week, and I think that's going to be a moot point. There's a number of things, and I'll go through this after I go through talking about what's coming out this week. But there's a number of things that folks are doing right now that are trying to apply some of the old rules to some new rules. And let's see, on Wednesday we got housing starts, so there again we've got more housing focus. Thursday, typical jobless and existing homes, so more homes. Leading indicators will be a nothing. There's not going to be much there. The one thing that is happening this week, as you'll see here on Friday, is that it's a quadruple witching, which is the multiple expirations all happening at once. So that means after we get through Wednesday, possibly some of this will start on Wednesday and Thursday. There'll be a lot of window dressing and things going on around this around the triple witching and just balancing out books, getting them ready for the next cycle, and all those kind of things. One of the things I'm going to go through this just for a few minutes, but there's really not interested in the analysis, but I want you to take a look at some of these things that are out here. Retail sales, consumer spending. You can see, we saw some really flattening of the retail sales. So there's been some softening going on, and it's just like almost everybody's not enthusiastic at the moment. And maybe it's just the lull before we get to the midterm elections. Discretionary trends, you'll see restaurant sales up a lot. Auto sales are flat, and this is one of the things that a lot of folks are talking about, is that you're not seeing the growth in housing and autos, and those aren't the areas I think the economy is really building off of right now. There's a number of other trends going on. Here is a really positive, and this was the point of the deregulation and the all the tariffs and the so-called trade wars, is that you're seeing a reemergence of the manufacturing industry, and we're not talking about necessarily the giant manufacturers. We're talking about mom and pop, smaller operations that are coming back to life, and you're seeing just a lot of vigor in the manufacturing areas, and especially in the typical states. You'd expect that around Pennsylvania and looking at Wisconsin even, and some of the other industrial zones that are out there. CPI, this was, I talked about this last week, this was a huge focus of the markets, and they came in really moderate. There wasn't the expansion. So just to filter in some Fed ideas here, is that the whole point of CPI and the raising of rates, a lot of folks have centered that around the expanding inflation. And you can see over here where my cursor is here, that we saw a big expansion, and that was expected to continue at a fairly large degree, and we saw a moderation. So, it's interesting. Medical costs, food costs are moderating. All these things are pretty interesting. It's a fairly detailed report, but you can see here. This is it's got the core CPI and consumer expectations and everything. Everything turned down. That was pretty much expected to maintain that momentum that we saw. And of course, this has been the big story, is the employment situation. We continue to see, job openings are climbing, and now the unemployed are going way down. We're seeing a lot of traction in the markets. And anyway, I think that's all I wanted to show you on this part here. But the point is that I've been listening to a lot of stuff, and because of the anniversary of Lehman, and back in 2008, just last week, I was reflecting on that, and certainly many of you that I met around that time weren't privy to the, I guess, advantageous scenario when I was talking about Lehman failing back in February of 2008, and everybody thought I was crazy. They're like, "You're telling me, over 100-year-old, institution is just going to disappear?" And I'm like, "Yeah," and along with a lot of others. And what we saw, of course, was that was the only company that didn't get bailed out. Bear Stearns went down and got kind of sucked in to it, got taken out, but Lehman, for one reason or another, they let it go. If AIG would have went down, I think that would have been catastrophic. That would have been like a nuclear bomb, a financial nuclear bomb. It would have taken out just about everything. But anyway, not to get deep into the old crisis scenario, but a lot of folks are applying, are coming out of the woods. Even I'm a fan of Ray Dalio. I think he's an amazingly intelligent guy. I've been concerned because he's been always behind the background for a lot of years, as far as, not really letting anybody know he's thinking. Now he's writing books after book. He's out on tours. He says he's giving back, and maybe he is. But everybody, Schiller and all these guys that reasonably called the crisis in 07, 08 are all coming out, and they're all talking about the next crisis. And I talked about this last week. It's interesting watching the media in general. It doesn't matter whether it's financial or media at all. Remember, there used to be news shows. Now everything's political, some kind of political forum that goes on. Very little news. I guess local news, they still do some of that, but even they have been sucked into that scenario. So what we're seeing here, though, is the financial media that we see all the time. They seem to be focused on whether the bull market. I'm going to bring up a graphic here, and you may recall this from a couple of weeks ago, but this shows every bull market we've had. And I believe they do get mature, but they also, one of the things that we've seen in this particular bull market, we've seen several rotations and what I call running corrections. And we kind of get this acceleration. It goes up, it consolidates, even sees some pretty good, maybe a 10, 12% decline in a couple areas since 09. There's been several of those, but nothing material where it rolls over and the end happens. And so what we get is these rolling corrections, and we literally saw one of those this year. It looked really bad. I'd spent months, like everyone, I guess, talking about the markets being broken, but they managed to repair themselves. And that's exactly what we're seeing again. We've surged to a new high, and we'll go into detail here in a few minutes, but we see this rotation starting to happen again. And so I guess I question the wisdom of trying to apply all of these old stats and things that happened before to the current. And are things worse than it would appear? Things are worse based on debt, but is it manageable? And if the Japanese have got anything to say with it, they've managed to really move and keep their economy reasonably stable, even though they've got this massive amount of debt. So does it break? It certainly is vulnerable, as big as it is, but it doesn't appear that there's anything to break it right now. And we still have a fair amount of momentum that's coming from the tax cuts and deregulation that's happening in the economy. So this thing can perpetuate quite a bit from where we are. So let's go ahead and start to dig into the technical part of the show. And I've tried to clean up some charts so you guys can see them. I was looking at some old broadcasts, and I'm like, some of these red lines I had on things were very difficult to see. You could hear me talking about it. It was very, the visuals weren't so good. So I've changed a fair amount of stuff here that I, just to make it a little easier to see. And this is actually a 30-minute graph, and we're already starting to see some stabilization. We went through the key area that I talked about on commentary at the 28.98. So we've skewed this thing from being a positive day after taking out that support number. Now we're most likely going to end up finishing lower. And, we just squeaked out the close over 29.04 on Friday. And then, we come in, of course, it's the same rhetoric that I'm talking about, where we're seeing the talk of tariffs and trade wars and all that. I keep telling everybody it's real simple to see who's winning. Just look at the Asian markets. Look at China down, in a 2016 low and then some now. They are under pressure because it's obvious that the tariffs are going to hurt them a lot more than us. So there will be a compromise. How long does it take? I don't know. Maybe it takes 2 more months. Maybe it takes 2 years. Maybe there has to be much more pain. And I keep my famous line that I keep throwing out at folks as, short-term pain for long-term gain. If we get a more fair system, these are issues that multiple administrations have talked about, but nobody has done anything about. And I guess the fact that Trump doesn't have any of the I guess the lobbyists pushing him behind and to keep him in line, and especially the globalists. You know, he scares these folks because he's willing to go and fight this battle, and of course, the dialogue around this is that somehow it's all going to derail and the world's going to come to an end, and that's probably not very likely, because there's a lot of really smart people around the trade, around these companies, and running the countries that know that it's not a win-win situation to go into a major war like this from a financial war. And so Trump is likely to win, like it or not. He's likely to win, and it's going to be a good thing for America, you know. And I saw some interesting things over the weekend that, you know, talking about how populism and nationalisms come into play, and they come after these really bad down cycles that happened after the Great Depression. You know, we had the Great Recession, and we're seeing that same type of movement, and it's happening not just here in the U.S., but other places on the planet as well. So the point is that these gyrations that we see in the markets are continuing to illustrate what is going on. So I don't know if I have a good index. I should have looked this up before the show. But if you look at the S&P here, I've got it now on a daily. Let's go full screen so you can see a little better. And what you can see here is that this sideways movement, we've been locked in for getting closer to the maybe the last 3 weeks. And what we're seeing here is that we're seeing this pattern just go sideways. You know, there was a good shot after closing on Friday for us to move higher, get up to around 2908, 12 level. We'll get close to the 2916.50, which was the high. We're getting closer, but we're not actually able to get above that. The momentum, if you notice here on the PPMs on the far right, I'll put a cursor over there, you'll see that they've moderated a lot since we made the high. You may recall me talking about this, but there was some real possibilities for this thing to accelerate from the points where it was, and it didn't make it. It just fizzled again. So these sawtooth stair-stepping patterns continue to emerge. And you can see up at the top here, I'll bring this on screen so you can see some of these numbers, but right here you see the high target, 2926 is a min. Been talking about this ever since this thing blew up out of this pattern. The next level is 2950 to 2965. Most likely, this thing may be just stagnant and waiting for the Fed to make a move next week. Not sure what's going to happen around that, but the bottom line is markets appear to be just locked in this pattern. And there's momentum's flattened, actually turning down a little bit. We go over to the intermediate graph here, and you'll see the same thing. Some moderation of the momentum here. PPMs are flattening out, but they are still very positive. You got PPM 1 at 0.34, PPM 2 at 0.38, and anything over 0.25, as you know, is a confirmed uptrend. And PPM 3 is flattened a little bit, and we're at 0.20. And so, but all of these are still very robust, very substantial trend levels that because it's a weekly graph, you're not going to see, a big rollover here. That's not even possible. Like 2884 level is pretty substantial support, and if we did get down to even the 2864 level, which is the low of last week, I think. Let's just bring that up. I've got it here. Yeah, 2866.78. That all of these numbers are going to represent major support. I talked about this in commentary and on the show last week. Is that there is the pattern suggests that 2866 level is going to be the low of this pattern, and all of action that we see as we go on over the next several weeks is going to be trading above those levels. Most likely that 28.84 is going to be the bottom, and around the highs at 29.12 to 16 are going to be the resistance. And we're going to lock into that zone. Most likely that's going to be the zones that we stay in all the way into the Fed meeting next Wednesday. And so we'll see what all that's about here. Let's go ahead and take a quick look at the monthly graphs, and so we can see exactly what's going on there. This is the same old pattern I've been talking about forever and ever. And what we're seeing is that the momentum has flattened off on both the ppm 1, 2, and 3, but they're all these crazy trend levels. 0.92 on the ppm 1, 1.23 on ppm 2, and 0.85. And we've maintained, I think, the lowest that we've been on ppm 3 through the worst, going all the way back into August of 2015 and including the first quarter of 2016 when we saw that dip. I call it the War of 1812. The low one was the first in August was 1812. The second, actually 1810. The next low was 1812 that we had early in 2016 before the markets turned around. And we've pretty much been in this robust trend ever since. And you can see that the pattern that we have, the moving averages are all spread out, which means let me just try to highlight an area here. I think I can. I'll put a couple highlights here and bring up the whiteboard here for a second. And what we'll see here is when we bring up the whiteboard, is bring up a couple areas. I'm going to attempt to do something here and just draw areas, but this, yeah, good. At least it'll highlight it in red. You'll see there. But these are areas where we have a lot of similarities in how the patterns are unfolding during these trends. So we get this acceleration, which we've had, then we flatten out and get another acceleration. And meanwhile, during these times right here, if I bring this up, you'll notice that I'm drawing some arrows here off the PPMs, that during these times, markets are still advancing, but the momentum continues to decline, but it stays above what I refer to as a trend level. And I've talked to you folks, especially long-term watchers of the show, that when you see this is actually what I was talking about in the beginning of the show, that running correction where things are correcting, even though they're going up, there's an internal correction going, and sometimes it's just a relief of the over. I don't believe in necessarily overbought, oversold. Really good markets stay overbought for a long time, and good and bad markets stay oversold. So there's not a big default. All the indicators I use are measuring what I call pure output of trend. So I don't get involved in, well, this one's overbought or oversold. It does get overbought and oversold, but that's not a basis for understanding trends. That's really, really too micromanaging some of the aspects, and that'll get you in a lot of trouble if you're doing some of your own analysis, is looking at overbought, oversold, RSI, stochastics. Those kind of indicators are 0 to 100 meters, and they'll just get up and just get stuck. And you can see divergences and all kinds of stuff, but it really doesn't bring you into a real solid analysis of what's going on within a trend. And I've been a trend follower literally since 1980, 81 is when I started the basic concepts that I use to analysis the market. So I've been doing this for a very long time, and it's my view of the world that I present to you folks every week. But this is something I've got, I've stood the test of the time, made a lot of good calls on the markets, and understanding these elements is what we're dealing with right now. Well, maybe we're about to get into another slight declining phase. I'm drawing some arrows. Let me go full screen so you can see this a little better. I draw some arrows on the outside of this chart, and you're seeing that maybe these are all going to start kind of moderating a little bit. Meanwhile, the markets are an upward slope. And as I've talked about these numbers on these PPMs, they on a monthly chart, all you have to do is maintain a point, really a 0.20, and it's enough there to keep the markets in control, I guess, from more gradual move to the upside. So I think these are important facts to have a handle on, because it tells you a lot about it tells you a lot about the internals of the trend. And that's where, if you just look at moving averages, I don't care what averages you look at, but if you just do moving averages, you're not going to understand some of the aspects. And that's why these PPMs were developed way back in 1983, is myself and an associate that were studying this stuff figured out that, yeah, the moving average is there, but can we figure out when the probabilities rise for them to be broken or into invert in their trend? And that's spent a lot of time on this, several years actually, and then been studying it for 30 some odd years now. And it really is very mechanical, and it really does support everything that I've been, all my work that I've done for, getting close to 38 years now, actually almost 39. So the point is that these trends are continuing. They're not likely to move over. Sorry about that. Meant to turn that off. Anyway, sorry about that. But anyway, the whole point of this is to be able to understand the trend, the internals of the trend, which will give you much more confidence over time. And that's what VPM's doing every Friday night when it crunches the numbers, and every month when we're running the secular models. If you're a Portfolio Expert user, we're making this analysis all the way through. So it's really important stuff to understand that not only is there a trend, but there's an internal part of the trend. And it's not about overbought and oversold. It's about the percentage of what I call the angle of attack and all those kind of things. So I guess a little education today. But it's important for me and for you folks to understand that this is all evolving inside of the work. And that's why sometimes I remember way back in 2010, and we were long emerging markets, and folks were wondering why weren't we selling EEM. Well, it turned out there was one more big run in EEM, and they went, oh, that's why. But because the internals of the trend at that time were still positive, they weren't negative, even though things looked like that. So I'm going to go off screen for just a second. I'm going to turn this sound off on this other box I have in here. I thought it was turned off. Hang with me. So let's go over to the next. Let's take a look and go into Portfolio Expert here, and if I can get to the right page, and we'll take a look at some of the dynamics that are happening here. And I thought I'd logged in, but I haven't, so it takes just a second. We'll get into the dashboard. So a little longer this today with the comments on a lot of things that are going on, but I really think in moments like right now when we are when we are actually treading water, a lot of negative stuff that is coming out, then you need to cover things in a little more detail and have a little more in-depth understanding. So bear with me while I log in here. And we'll take a look at we'll take a look here at the dashboard a little bit, and you'll see that we did manage to have a slight negative rotation this week. But overall, I talked about this in depth last week, and you'll see here, we've been maintaining around this 49, 48% for multiple weeks now, and this has been the norm. The rotation, you see a little red, little green on almost every one of the bars on a sector basis. We come down to the groups, you'll see some mix, but there tends to been more traction coming in some of these groups than there has in the past. But most of them, once again, 40 to 60 percentile range is where we continue to stay, and there's not a lot there that will there's not a lot there that will actually change any outlook on the market. So we'll go over to VPM 2.0 here, and let me just get logged in there. I apologize. I think it logged me out. I closed the program by accident. So, and as we look at this, we'll see that what's emerging here is that maintenance of that 48%, and that's key to watch. But we're still 66% of the sectors are long. We've got 52% of the groups, and I talked a fair amount of detail on this last week, is that we're continuing just to see this maintenance around this 45, and I don't think we're going to get much over 55. The peaks are usually around 62 to 64 on as far as the if we go over to the home page here just for a second and we bring up this graph here, you'll see that this is make this a little bigger so you can see it, but this is pretty typical where we see markets going up and the actual percent bullish on each new run gets less and less. And of course, this was the peak here. Let me just bring it so we can see the dates at the bottom. And back in 2017, when we were really starting this next bull market, when it's starting to accelerate, that's when we saw the markets just scream on the upside. And then you see, as it was going up, the percent long, we saw rotation. And what that means is that there were trends that were broken, but there were the trends that were driving. Now this is the this is SPX. So the S&P continued to drive forward, and as we all know, there's a small subset of stocks that are really driving this thing, and that's why you see the background of the database. When we're looking at 18,000 symbols, you see the background change a little bit. And you see, it was interesting that right at the spike we saw a pickup in trends, and then right after the spike we saw that pick up. That was around January 26th. We just saw the collapse, and we went all the way back into the 32, 36 percentile range, and now we've climbed back from those levels. So, as we look at all of the database that we're looking at here, you just see this continuing rotation. You see we had a slight negative rotation. Let me make this a little larger so you can see this. But you can see over here you had some negative rotation on the weekly 1-2 and 3-2. You saw a few more sells than what we had in the and buys coming in, and that was the negative 200 and change that I was showing you on the dashboard. And so we're just continuing to see a bit of a negative rotation up here, and we're trading at all-time new highs. You can look at the S&P chart over here, and you can see this thing is it's grinding out, but this is typically how it works, and this is why I'm going through the great detail I am today on these trends and what's going on, and especially within the database itself. So when you're looking at this stuff, you're going to see that rotation happening, and you can also see that there's pretty decent returns on the sector indices from the VPM purchase of them. Consumer cyclicals, one of the best, and healthcare's done well. It's almost when you get into the groups. If we go over to the group button here in 2.0, you'll see a lot more rotation, and you can look at more of the details of group by group. And if you don't do this on a regular basis, you should. And then you look at all the groups that are flat, and then there's tobacco was one new group that popped in, and it spiked up. That data could be suspect. Sometimes in some of these subgroups like this, we'll get a symbol that has some bad data, or micro cap, or we go down to about 300 million on our capitalization and our indexes. So we go down into what would be considered a micro cap anyway. So as we look at everything here on the dashboard, you can see, like I said, this rotation that is occurring. You can see since I'm going back here all the way to after July 9th, you can see from 7/24 forward, what you're going to see is there's just been a rotation, buying and selling. So we've been just rotating this market for some time, and this is why, I said the markets are bored. There's just no leadership. There's nothing really to go on. The negative story of tariffs and trade wars really haven't done anything. In fact, since they came out, markets are substantially higher since all the talk around that. And if you go to the CNBC's and even on Fox Business, you'll see it. CNBC seems to be a little more negative. They're pretty much in the hate Trump mode all the time. So they're always demonizing trying to demonize this whole scenario, what's going on. And of course, none of us know what the outcome is. And, whatever the tactics are, when you're fighting a war, whether it's a trade war or something else, you have to be willing, you have to have some tactics and go through. And sometimes in wars, it doesn't look very pretty until you find out who won. And, like I've said before, I don't see I think for China, it's a lose-lose. They've got everything to lose, But anyway, let's go ahead and get back into the technical side here, and let's dig into a couple things. Let's go into interest rates, and let's talk about the Fed a little bit. So looking at the 10-year today, we did see the 10-year spike up. This is the monthly model, so let me go all the way down into daily. And in fact, let's go into a micro trend. Let's look at the hourly graph, and you'll see where I put my cursor here. Right up here, this morning, we got to 302 exactly. The old taper tantrum high was 3.01. And that it got exceeded, but it was exceeded previously. If we went to the daily graph, you'd see that we exceeded that. We got up to 311. So, and then immediately backed off of that. It doesn't appear that yields want to stay over 3% on a 10-year yet. We'll see how that plays out. Next week or so, we see another quarter rise in the Fed funds rate, and that's probably going to be enough to push this thing up. And we'll talk about that in a few minutes here. If we look at the daily graph on the 10-year, you're going to see something interesting. We got some Fibonacci objectives for to go back and retest the high at 312 on the daily. If we go to the weekly, it gets a little more interesting here. And what you'll see is that the objectives on the daily or on the weekly, a little higher, 309, 314, still around that same range. And I've talked about this a fair amount, that I think we're not going to get much above 310. Maybe we can go 312, but I don't think it wants to stay there. So I think we'll end up setting up a trading range for yields on a 10-year somewhere around, 290. I've been talking about it for a while, 278 to 301. We're pushing the top end of that range now, and good chance because of next week and the Fed has got right now it's 100% probability that they're going to raise rates. So they're going to keep pushing, and I'm going to go through a yield chart so we can see this, but they're going to keep pushing this stuff higher so that it's going to cause some relative movement in the yield curve for all boats to rise, if you will. So you'll see the 10-year rise above 3, and then we'll look at all the yields here in a minute, but they're going to push everything up a little bit, maybe not a full 25 basis points on the long end. So we're likely to see that contraction of the yield curve yet, but I think you're going to see at least 10 or 12 basis points, which should put us at these levels that all these objectives are telling us that we're going to go to. Let's take a look at the monthly here. And monthly has, I think, probably the best perspective. And, the reason why I look at these multi-variant charts and length is that as you start like going into a micro, we look at an hourly graph, you see all the noise in the markets, and you obviously I could go down to a minute-by-minute graph if I wanted to, or even ticks. But the point is that when you get into, as you go up in the spectrum of time, and that's why we use the weekly graphs for our primary modeling for our strategies, is because it eliminates a lot of that noise. So you start to compile the volatility into these larger data points or longer term data points. And monthlies can be really good. If you look at, I think it's maybe it's 1.2, I could bring it up, 1.2 monthly or 3.2 on the S&P. It's been long since 2012. It's never had an exit. And that's fine. You have to ask yourself, can you handle that kind of volatility? I would rather be in and out a few times and not take the risk of a larger trend to roll over and get caught and give back a lot more in the markets. And, I have, I'll call it a super secret project of trying to model, like we talked a lot. There's actually on our dashboard, there's multivariant charts. They kind of go one way. You start with a daily model and go to weekly and go to monthly. It needs to revert back. So at some stage when these markets get really expanded and extended, that there's a rotation back to a short term for the exit. And I'm working on a project right now that I hopefully will solve some of those issues. And there'll be some new modeling possibilities for some of these secular trends. But when we look at the monthly, this on the 10-year, it becomes pretty obvious here. And I'll go full screen here so you can see this. So we look at the objectives on the upside on the monthly, on the 10-year. You're going to see high targets are quite a bit higher, 3.62. 3.97 and 4.18. So that's way up here if you can see these. And then and I have no idea, I haven't really tested a lot, but there seems to be validity on other charts, but the 200-month moving average right now is 3.22. And I actually think that this level is going to be where we end up going to. We're probably going to go to around between 314. We're talking about some of these objectives on these charts, 314 to 322. That's still going to be healthy. Mortgage rates are going to move up. Maybe we're going to see, I've talked about for years, when mortgage rates actually finally start to go up, I think initially there's going to be a surge in activity around real estate because people are going to want to try to beat the increase in yields, and we'll see how that plays out. But this chart here is really telling us where the things are likely to go in the longer term. And if I go over here and we'll take a look, I said I'd go to these charts. You notice my spread charts are a lot easier to see now. But this chart here is all of the yields all together. You can see that the 13-week, which was the yellow line on the bottom, that is all the way up to 2.210 now. We're at, like I said, we're 299 on the 10-year. We're at 312, almost 313 on the 30-year. So those spreads are really tight and you can see this, especially when we look at these yield graphs here. You can see that this will go. Let me go full screen so you can see this a bit better. You'll see that we're not in a flattener again, but we have moved back down, and I've seen this in the last couple moves on the Fed, where the yields will start to you'll see this flattener come in, and then they'll crank the yields, and then we'll get it. They'll change those spreads or maintain them, but they've tended to steepen a little bit, and that's what I was talking about before. So this is pretty substantial as far as that goes. This is the let me see what chart I got here. Sorry, this is the chart I wanted. So this is all the way down to 0.95 on the 1030s, and so we're going to see this thing maybe flatten a little bit more into next week, and then we should see it pop out of there. So let's do a couple things really quickly here, because I've taken a lot of time on this stuff today. Let's take a look at the dollar. That seems to be big on everybody's mind right now, and I've spent a fair amount of time in the past talking about this. And you'll see the dollar is at 94. It got down to as far as 89, and it's bounced back. I still think this entire zone that we're looking at here is this sideways pattern that we're looking at, all the way from 15. Now this is the monthly we're looking at. All of this is just setting up a move. There's, I think, a very strong move going to occur, maybe around to 105, 110. I'm kind of back on that on a longer term basis. On an intermediate term, we look here at the weekly, you're going to see this pattern set up. We've got a nice rising 21 period moving average. It's rising at 0.17. It's got a lot of support behind it, but we can get above this level right here, which is 96 and a half. This thing will run quite a bit, and we'll start to get some new Fibonacci projections there. I'm just going to buzz through several markets here fairly quick. Let's take a look at gold. Continues to move off the lows that it had over here, where it got down to that 1160. I talked a bit about that last week, and what you'll see here is we're right at the resistance. This is a weekly resistance at 1212. We're currently 1207. We've been as high as 1209. So we're trying to break through the next level, and I've talked about this a fair amount, is 1240, 1255. That's going to be your next move on gold, and that should finally, that move up to those levels, if we can get to somewhere between 1230 and 1250, that's going to set up the pattern that will emerge into a bigger pattern that will start to move up to around the 1300, 1350. And as I've talked about before, longer term, I still think we're going to see some pretty significant numbers on gold. But I believe, actually, let's just go to the monthly graph real quick here on the side screen. But you can see that this pattern has just been flat. We are likely to see this thing move, I think, at least toward the 16 to 1800 level. And is that going to be a hedge because the markets finally roll over, something else happens? I think the only risk that I know that we have right now is if somehow that the other side of the aisle, will just say, was able to remove Trump from office. And, whether they say be careful what you wish for, would be, I think, a disaster for the U.S. It would be a constitutional crisis. There would be a lot of implications. And, we live on our integrity of our system, and there's a lot of problems with it for sure right now. But what we're seeing is that, this may be the point to hedge. I've been telling you all for several months now, and we've not really had that have it come in. But put in GLD if you want, and have an alternative sleeve on one of your strategies, because I think that the next buy out of GLD is going to be one that's going to be pretty big, sustainable move. And so what might happen on that is that we would get let me go to the weekly graph so you can see some of what I'm talking about here. What's likely to happen here is as this pattern sets up, then we could see initial buy, maybe a small profitable trade, and it might be the second trade. See, a lot of folks that use our process are expecting that every trade is the perfect trade, and it finds that there are a lot of them that are. But in this kind of pattern, when you're coming after a steep decline, you typically get the first trade will win, maybe a small loser. The second trade can be the big one. We've seen this on stocks like Netflix and things like that, where we get we get a trade, maybe we get a loser, and the second trade, is 200, 300, 400% returns on some of these trades. So it's not always the first trade; it's the second trade. So if this thing is on your radar screen, or any stock that you have that still is in your screens or whatever, you stay with them. You let them rotate. You let it. You have. Sometimes we used to joke you got to do the same trade 3 times to get it right, and you might actually buy it better or worse depending on what's going on. I've seen people actually talk about, well, if EPM sells, we have to buy lower to show that we added value. Well, that's just complete, boulder dash. It doesn't matter where you buy. The trades aren't. Every trade is an individual that emerges, but definitely, I'm still big on this thing, and it's a strategy I'm doing for myself and my family, and I just want you guys to know what's going on there. Okay, let's move on. We don't have a lot of time. I said I was going to go through some of the things, so let's do that right now. Let's take a look at, and let's talk about the ultimate censorship here with Facebook. They continue to go down. I talked to you, I think 2 weeks ago, about this stock, and I told you that 159 was probably the limit. We've been hanging right above that number, and I'll show you where that comes from. This is the weekly. This is the monthly graph here, and we went through this 21. And this range, this is a monthly range. I'm going to bring this on screen. You'll see right here, these are where the numbers that you see on commentary come up. You can run these numbers within TradeStation on any symbol in the world. It'll tell you what the monthly range is likely to be, what the daily or even an hourly or a 1 minute. It'll give you a range. But in this case, on Facebook, you can see this month's range is 168.86, 161.53. So 161.19, we are like right there on S2 for the month, and this is for the month of September. So it's pretty much satisfied that. I think we're still at an extreme, but if this thing continues to go down, then that next level down is 153, 146. And that's retracing a lot of this last rally that we had. Quickly, let's go over to Amazon. And let's go over to start with the daily real quick. And the daily, you can see after peaking out on the 4th of September, we've seen this thing move back down. It's moved all the way down to the daily 40 moving average. Put this on the screen so you can see it. And I'll go full screen. And what you'll see is there's a target of low target 1875. And so we're a little ways away from that, but the 40 period moving average is 1899. So my expectation is that we will, since we have a 0.15 ppm on the 40 day moving averages, that we'll definitely hold that level. If we get any closer to it, it's likely to be, the extreme. We've seen 1887 low, with the average at the 1901. So we're really have already worked this range, and I expect that we're going to stabilize here. And some of the weakness we're seeing in the composite may firm up here in the next day or so. I think there's a little more work to go there yet as well. So let's do another one. Let's look at Netflix. It's been having its issues as well. Daily Netflix spiked out. We now see this consolidation. What we're seeing here on Netflix is a target range of 401 to 442 on the upside. It's going to have to hold these key levels, and those levels are going to be at that around the 350 level. We got to stay above 350 on a closing basis, and that on a short-term basis, that'll do it. We go to the weekly graph. We'll see that all of the moving averages are congregating. At least the 10 and 21 are, and the 10 has got a pretty good downslope right now of 1.14, and the PPM2 is at 0.58. So they're most likely the PPM2 will win out, and that'll tell us that there's quite a bit of support here. So one of the things I wanted to talk about and demonstrate to you as we get into the final 5 minutes of the show is that a lot of these charts are actually coming into support, and we're not likely to see the fangs, and which have obviously led the markets, especially in the NASDAQ, a lot higher. So you're still seeing, I think, that final rotation of these stocks to move out. And if you're trading any of these things, if you're trying to do a multivariate approach, you could use a daily graph on here and probably find a quick rotation in. So let's finish the show off, do a very, very quick review. I did actually brought this chart up by accident, but let's take a look at it since I've got it there real quick. This actually shows you, let me go to the daily, and you'll see this is a view of, instead of having just dots up there, these are actually the price objectives for the markets, including it's got the moving averages on it, a number of things. And you can see how the flatness of what we've been trading here, and this is on a daily basis, it gets even worse when we go into the weekly. You can see all of these things are just kind of flattened out, and you see these expansions, these little spikes down. These tend to be when the lows are coming in play, as you can see here. They're similar in a way if you were to use standard deviation lines, often referred to as Bollinger Bands. But if you get these big expansions when the markets are about to change directions and get these bubbles around them. And these are actually just the Fibonacci projections that we have off of everything. So let's go over and take a quick look. We'll finish on the NASDAQ here and bring that up real quick. This is the weekly composite. You can see we're right on the 10-week moving average. And that number is 78.93. We're 79.41, so that's going to be good support. We only have a 0.15 ppm on the ppm1, so that's enough to hold the support, but it's even quite a bit below where we are right now. The low today has been low has been 79.17, so we're a pretty good chunk off the lows already. I suspect this will continue to recover and probably end up back around, 79.20 or so, and 79.20, 79.82, maybe as high, move back up towards the 8,000 level. But I don't see this thing, like I said, just based on looking at the fangs, looking at everything that we've been looking at on the show today, as seeing any major rollover or any major risk here. We're seeing really this consolidation and rotation of some stocks, And, there's still all of these stocks on a Facebook's probably the weaker of all of them, but they probably have the most trouble. I didn't bring up Twitter. It's not really one of the fangs, but that thing is just getting hammered, and it seems that censorship is being punished right now. And so the point of this is that these trends on the fangs, and I didn't bring up Apple. That's probably worth looking at. I hate to do this, but I want to do this just to take a look at this with you guys and take a look at it. But you can see Apple also got a 1.37 ppm, 1.39, and 0.62. And the point of what I was just about to say, and I had that synapse about Apple, is that these things are all in major uptrends. They're not rolling over. This is not the end. I guess I'll end the show saying that there's a lot to go on yet. And I suspect that once we get past the Fed increase, that we could see this thing, September is supposed to be a negative month. It doesn't look like it's going to end up that way, but we're only halfway through. So maybe there's more things to come. So anyway, I think my whole hypothesis for the last hour really is that all these trends are in place. The idea that interest rates right now are going to derail these trends is not the case. The tariffs are not going to derail anything. The trade wars are not. And in fact, I wouldn't be at all surprised if we ultimately see some pretty positive events out of the U.S. Chinese actually going to the table. They're talking. Trust me, we don't hear everything, and we shouldn't. And so they're talking about how to handle this stuff. And I wouldn't be at all surprised if we see some kind of deal, like I said, whether it's 2 months or 2 years, there's one coming because China's got more to lose. Anyway, folks, thanks for watching. I really appreciate it. I'm glad we had a nice, smooth show with no technology, blackout screens, and all that. But have a great week. We'll talk to you next week at the same time.